Well, good morning, everyone. My name is Samir Abdullahi. I'm the Deputy Director for Select Fulton. Select Fulton is the economic and workforce development arm of Fulton County government. And we're excited to have you at our second quarter Empowering Entrepreneurs webinar series, again, hosted by Select Fulton and Fulton County government. As Select Fulton, we work to stimulate development, help companies grow locally, and make sure that we have a skilled workforce. Today, again, is our second quarterly webinar series, which we created to help support small businesses, especially during these challenging and unique times. It's essential that we continue to provide support and foster an environment for businesses like yours to grow in Fulton County. And that's why we've created today's agenda around access to capital. We have an exciting lineup of experts that will help us walk through that today. We have three presenters from Access to Capital for Entrepreneurs, better known as ACE. ACE is an Atlanta-based 501c3 nonprofit and community development financial institution, also known as a CDFI, that has provided over $97 million in loans and business advisory services to support 1,400 plus small business owners and create over 12,000 plus jobs for Georgians. So definitely experts, both in the small business and entrepreneurial level. I think they've seen a lot of different types of businesses and different industries and different stages of growth. So again, really excited to have them on board today. The individuals we'll have are Chris Clay, Ray Penny, and Eric Swilling that will speak a little bit about ACE as an organization, how they help position their clients and small business owners to access capital, and kind of best practices that they see along the way based on their experience. So again, thank you for joining us at Fulton County today. But before we kick off with the ACE team, we wanted to invite a special guest on to speak to the audience. We've invited Commissioner Liz Hausman, who's a big cheerleader and a big fan of economic development and small business development here in Fulton County. She's the District 1 Commissioner for the Fulton County Board of Commissioners. She's a strong passion for community engagement and community service, and wanted to invite her on to just offer a few brief remarks to open us up today. Commissioner Hausman.
Well, thank you, Samir, for those kind words and for inviting me to be with you today. As the executive sponsor for economic development for the Fulton County Board of Commissioners, we worked together in 2016 to create Select Fulton to better support our business community. And while Fulton County continues to be very successful in large corporate investments like Microsoft, Google, and Twitter, we recognize that small business is the heartbeat of our economy. And that's because 92% of all businesses in Fulton County have less than 4 employees. And similarly, our Fulton County residents have a strong entrepreneurial spirit that are creating the next products and services of the future. 73% of all businesses in Fulton County have no employees at all. So they're single sole proprietors, if you will. Similarly, our Fulton County, I'm excited to kick off today's Empowering Entrepreneurs event with Access to Capital for Entrepreneurs, also known as ACE. ACE has been a great partner for Fulton County in the past, helping to support the county's $3 million emergency small business loan program we had last year during the pandemic. They bring real-world expert knowledge on how to better prepare your business for lending opportunities and where those opportunities exist. So thank you all for joining us today, and I look forward to a great discussion.
Thank you, Commissioner Hausman. I'm glad you reminded us about the small business program that ACE managed for us. If you remember, over 72% of businesses that received loans were minority and female-owned businesses. And so I think Fulton County not only was one of the first to deploy small business loans early on during the pandemic, but really took a targeted approach to reach out to groups that weren't traditionally served by some of the federal funding like PPP and the others. And I think we'll have another program and opportunity upcoming to work with ACE on another small business revolving loan program with more details to be announced down the road. So again, with that, I will turn it over to Chris at ACE and pull up the presentation as we start to go through their discussion around access to capital for entrepreneurs, the work that they do and opportunities for small businesses in terms of best practices to access that capital. So Chris.
Thank you, Samir, for the warm introduction, and thank you, Commissioner, for having ACE as your CDFI of choice. Once again, everyone, welcome to the presentation. Today's topic is small business access to capital. My name is Chris Clay. I am a commercial loan officer for Access to Capital for Entrepreneurs. Joining me on our call today is Mr. Eric Swilling. Eric is our Senior Credit Officer. Mr. Ray Penny, our Chief of Business Advisory Services. Also joining us on the call is micro lender Ms. Vanita Dosser. We'll get a chance to hear from each of them later on in the presentation. The goal of this presentation is for you to leave a little bit more knowledgeable around the lending process, particularly as it pertains to obtaining capital from ACE. But with that being stated, please let us know if you have any questions as we will allocate time for Q&A at the end. Please use the chat box on your screen throughout the presentation, and Eric, Ray, and I will answer as many questions as possible. If you have any questions that are more specific to your business, please email me at clay@aceloans.org. That's CLAY@aceloans.org. Next slide, Samir. To provide a little bit of background about ACE, we are a CDFI, as Samir stated, which stands for Community Development Financial Institutions. CDFIs are primarily private financial institutions that are 100% dedicated to delivering responsible, affordable lending, especially to disadvantaged communities. ACE is a 21-year-old nonprofit with 3 locations. Our home office and our founding office is in Cleveland, Georgia. Our Women's Business Center is in Norcross, Georgia. And our Atlanta office is inside the Rice Building on the 2nd floor. The Rice Building is also where myself, Ray, Eric, and Benita and I all share when we're not working remotely. So please stop in at any time to say hi. At ACE, we provide 3 primary services, with the first being capital, which is our lending side of the house, followed closely by coaching and connections, which falls upon the Ray's umbrella, which you'll hear from later. And I should clarify that our Women's Business Center is not just for women only, it is for any aspiring or existing entrepreneurs that can take advantage of our services. Next slide. If you take a closer look at our 3-legged stool, capital, coaching, and connections, you'll see that coaching comes in different forms, i.e. technical assistance and business cohorts. We're going to touch on each of these topics today more in depth as we move through the presentation. But just as a quick rundown, our micro loans run from $15,000 to $50,000, and our commercial loans range from $50,000 to $250,000. Although we can exclude, we can execute loans much higher, up to $1 million. And Eric will talk about that more later and how we match our loan products with our programs. But our true competitive advantage here at ACE is not just the loans we provide, but the support you receive before and after the loan is made, which entails technical assistance, personalized coaching, business cohort, and networking opportunities. And again, Ray and his group will provide a little bit more information about that as we proceed. Next slide. To briefly recap how ACE performed in 2020, we issued $25.1 million in lending capital, of which 90% went to underserved populations, 50% went to women-owned businesses, and 39% went to African-American-owned businesses. 17% went to Hispanic-owned businesses. We're proud to highlight these facts because it's important to our company and to the people that we serve that we remain a mission-based lender that cares about our underserved community. Next slide. So without further ado, let's discuss what you'll need to prepare your business for access to capital. As we deep dive into what it takes to access capital, we acknowledge that there are many forms of capital you could receive, such as grant capital, debt capital, equity, and angel or venture capital. But no matter what type of capital you receive, there's always a give and take component. So regardless of the capital you apply for, there are typically a few common factors, such as a business plan, a mission statement, satisfactory business statements, financial statements. And this presentation is obviously centered around the debt capital component. Next slide. When you're in need of debt capital, there's a fairly simple roadmap you could follow. It starts with your personal credit score, clear financial statements to explain your cash flow or financial health of your business. And this is typically done through income statements and balance sheets. You'll also need capital investment, which is a form of a down payment or owner's equity. Of course, collateral is always necessary, and a business plan or executive summary. Next slide. When an underwriter or senior credit officer, such as Eric, reviews a file, they usually follow a model predetermined by the organization itself. At ACE, we use the 3 C's of credit model. Again, there are other models that you may have heard of out there, such as the 5 C's of credit, which consist of capacity, collateral, capital, conditions, or character. But at ACE, we use the 3 C's of credit model: credit, character, cash flow, and collateral. Character plays a key role in whether a loan application is approved. Character is basically your business background, familiarity with the industry you're in, and your personal credit history. Cash flow is also very important. Cash flow is the movement of money. But honestly, this is the part where ACE, where we're here to help you. If the loan will cause undue harm to your business, then we typically won't do the loan. If the loan will help your business, we will definitely look to strive to make the loan happen. Last but not least is collateral. All lenders want to make sure that the borrower is taking some risk. So if I put up a guaranteed asset, such as real estate or property, the lender understands you're serious about repaying the loan. And if character, cash flow, and collateral are all in line, usually it's a good loan for us to make. Next slide. If I had to pick one question that I get the most, and I mean the absolute most, would be, what does my credit score have to be? And truly, this is a slippery slope to answer, because the honest answer, it depends. If you have a 600 credit score due to a recent divorce or medical situation, here at ACE, we look to overcome those objectives. If you have a 600 credit score due to a recent foreclosure or repossession, again, those factors may change the scenario. But what I can assure you that we do consider all factors that contribute to the credit score. But as I stated earlier, credit is just one decision, one component of the entire credit matrix. You also have cash flow and collateral. Here at ACE, we use Equifax as our bureau of choice. And I would venture to say that the minimum credit score for most traditional banks likely resides in the 650 to 660 range. So having a lower minimum range is a competitive advantage for ACE as well. Some creditors do pull your business credit report scores, but for now, ACE has suspended business credit reports, as most of our clients are early stage businesses and usually do not require or do not have a business credit history. Next slide. Hopefully I'm not sharing anything new here with this particular slide, but what makes a credit score is consistent of your payment history, the amount that you owe, your length of credit, new credit, and types of credit. If you need help improving your personal credit, we have wonderful people at the Women's Business Center and Business Advisory Services that can provide resources to help you with that. Next slide. A few common tips to help you manage your credit. You always want to make sure you pay off debt instead of moving around. You don't want to close or open unnecessary accounts. You want to definitely rate shop within that 2-week time span so that you reduce the amount of inquiries on your credit report. You want to check your credit report regularly. There's resources out there such as Credit Karma or Credit Sesame that can be of help. They're not always accurate, but they do tell you whether your credit score is going up or going down. Next slide. Always protect your credit. That's the most important thing. If you have errors on your credit, go ahead and write those out and explain them. Provide those to the credit bureau as well as to your loan officer. Avoid using credit repair or quick fix companies. These usually are not beneficial in the long run. Avoid as many inquiries as possible. Pay off collections if you can, and keep your balances low. Usually below 30% is typically a good range. Next slide. Nothing is more critical than business survival for business survival than access to credit and a healthy cash flow. Cash flow, again, is the money that's moving in and out of your business in a month. Although sometimes it does seem that cash flow only goes one way out of the business, it does flow both ways. Cash is coming in from customers or clients who are buying your products and services. Cash is going out of your business in the form of payments like expenses, rent, mortgage, or monthly loan payments. And to be honest, more businesses fail for lack of cash flow than for lack of profit. And at ACE, we look at what's called a debt to gross income ratio, and that we take your debt or monthly expenses, including your monthly payment for your new loan request, and we divide that by your monthly income or revenue. This gives us a ratio that hopefully falls under the 45% threshold. Not all banks or CDFIs calculate free cash flow the same way. Some financial institutions provide add backs, some do not. I would say that this is probably the most institutional based metric when it comes to the credit decision, and it can vary in multiple ways. But ultimately, what banks and CDFIs are trying to get to is a debt service coverage ratio. For us, that ratio is 1-to-1 or 1.10, while most traditional financial institutions want to see you cover your debt at 1.25. Next slide. Capital investment. What is your investment? What is your skin in the game? Be prepared to provide cash injection. Typically, lenders want to see a minimum of 10 to 30% of your own funds or resources invested. We don't want to put our money in something that you're not willing to put your money in. We want to see that there's risk on both sides of the coin. Next slide. Collateral can consist of assets that are usable in the business, as well as personal assets that remain outside of the business. Most traditional lenders require collateral with small business loans, but there are some lenders who do not require a specific type or value of collateral to approve a loan. At ACE, we look for a 1-to-1 ratio. Essentially, if you're looking to borrow $20,000, we look at the collateral to be valued at $20,000 as well, if not more. If you're purchasing an asset such as a truck or a car, we typically send the loan proceeds directly to the vendor. Other collateral could be a blanket lien on all assets, equipment, personal vehicles, real estate, your personal home. We're even willing to take a second position if it makes sense. Just make sure you have a sources and uses chart, and typically you'll see what your collateral should be or what it could be. Next slide. As I mentioned earlier, we have two primary loan types, micro and commercial, and we attempt to offset our loans with a variety of programs to reduce the interest rate, extend the terms, or assist with payments. Eric's going to talk more about that later on, how we can use our two loan products to place them in several different programs. And the next two slides we're going to see are just snapshots of our small and commercial loan term sheets. Next slide. This one is just a brief snapshot of what a small business loan would look like. But the term could go up to 72 months, a rate of anywhere between 5 to 7.75%. And usually our fees are around 1.25 to 2% of the loan amount. Next slide. And this is the exact same thing, just for the commercial loan, not much of a difference other than the fee and the interest rate. Next slide. And that's kind of it, guys. I mean, there's 3 C's of credit: credit, character, and cash flow. 3 C's of credit, I apologize: character, cash flow, and credit. To recap, your credit score should be around 600 or be above 600. Your cash flow is the documentation that you demonstrate that you generate revenue or retain enough net profit to repay a loan. Your debt to income ratio should not be any more than 45%. And our business advisory services can help ensure your documents are in order. We highly recommend, for those of you that are starting a new venture, that you keep your current job or have an outside source of income to show revenue streams. That helps with the loan approval or to show multiple sources of income. Please be prepared to provide your personal tax returns at all times up to 3 years, as well as your business tax returns and interim statements. Some traditional lenders may require that your financial statements are compiled or reviewed by a CPA. At ACE, we do accept internally prepared statements, but just keep in mind that some traditional lenders may require those to be reviewed. For startups, we do look at personal income sources, projections, and performance. And for established businesses, we look at financial statements of all parties. In fact, if they own 19% of the business or more, we have to look at their financials. Next slide. And again, I know that we didn't cover every scenario. It's impossible, but make sure you visit the sba.gov or SBDC, your local office, or your Women's Business Development Center, or the one here at ACE, and you can always get more resources. The SBA.gov has a lot of resources there to help you prepare for your loan. And next slide. And at this point, what I'll do is allow Ray and Eric to discuss their side of the business just for a brief moment to discuss some additional resources that are out there for you. Eric will wrap us up with a brief highlight of a few special programs we have right now that you can apply for. But first, here's Mr. Ray Penny to talk about our Women's Business Center.
Good morning, everybody. Thank you very much, Chris, for the introduction. Absolutely pleased to speak to our Women's Business Center, but also to our business advisory services as a whole. Our Women's Business Centers, I'll start with that, have been established since 2014. And Samir, if you could just advance the next slide, please. It's a network of over 125 women's business centers, which have expanded now to 135. And I'm proud to say that through the fantastic work that our team in our Atlanta Metro or Norcross office have been doing since 2014, we were able to be approved for an additional women's business center, which will be helping the community of Savannah, Georgia, and the rural communities surrounding that, as well as the veteran bases nearby. So just very pleased that we have yet another opportunity to stand up, as Chris referenced, number 2 and 3 of the 3 C's of ACE. We are all about coaching, providing resources, providing both pre-loan and post-loan help for our clients to help them remain long-term sustainable for the future. Some of the product offerings that our women's business centers do offer, and again, like a lot of the businesses I'm sure represented on the call, we had to do a little bit of pivoting, and so no in-person and all virtual, and slowly but surely we're getting back to what we're finding is going to be our new normal. And so the workshops and business series that we offer, as well as our lunch and learn webinars, we're doing 2 to 3 of those on a monthly basis. You'll have links to all of this at the end of the presentation that Samir will be sending out. And so if you click on any of these links, they'll gain you access to our calendar of events and all the wonderful programs and things that we're offering for resources for the small business owners on the call. Our team also offers one-on-one business consultations. And I'm also proud to say that we're bolstering our internal staff with financial advisors, subject matter experts that will be able to help, again, those small businesses, both in the microloan space as well as the commercial loan space. And really with the focus drilling down on financial acumen to help understanding balance sheets, income statements, profit and loss statements. So it's very important. Those pieces of it. The other pieces are important as well. We have a myriad of community partners, some backed by SBA like the SBDC or SCORE, and then also other nonprofits that are in the space offering services. So hypothetically, if you need a marketing plan or you need website creation, things like that, we have a very strong network of other potential partners that we can collaborate with and get you the necessary resources and tools. Some of the things that we cover in our webinars and beyond are 10 steps to starting a business, information sessions like this about access to capital and our loan products. We have a wonderful online learning platform that I'll explain in a second here, as well as our annual, I got to give a plug for our annual speed coaching event. It's normally our largest and most important event that we've had in person. And so think of a speed dating type model with subject matter experts. This year, we're going to be doing it virtually. And I strongly encourage anybody on the call to take advantage of it and to sign up for it. What you're going to get is 20 minutes with the subject matter experts, whether it be legal advice, whether it be advice around your finances. There's just many pieces of the puzzle that you'll have basically running into breakout rooms to be able to avail yourselves of these wonderful services. We also do our annual Minority Business Expo, have an amazing series for women-owned businesses around small business certification for contracting work with both local and federal governments. Next slide, please. I wanted to share about this, and this is for those of you, normally I would say, okay, our Dream Builders online education platform is really for startup businesses. But because of the pandemic, and really there are a lot of existing businesses that may have had a business plan that they formulated 5 years ago, 10 years ago, or what have you. It's a wonderful platform that you can leverage both as a startup business as well as an existing business that's looking to pivot and change their model, especially in light of what happened in 2020 during the pandemic. 13 interactive courses. As you go through the courses and complete each section, what ultimately comes out at the end of it is a wonderful document that provides an actual business plan for you to be able to take to your lender to say, okay, I'm starting my business. I've thought this through. I've looked at every potential component of it, whether it be the actual starting of the business, exploring your idea, vetting your competition, the marketing and selling, more importantly, the pricing piece of it, financials, all of those various components that make up a business plan will be taught through the learning module. Just a wonderful opportunity there. And again, for those of you existing, it'll enable you and give you some wonderful tools to help tweak and pivot your business as we go through the pandemic. And then the last slide for me, I believe. Next slide, please. Okay, and so my point here, there's a myriad of resources. The webinars that we do offer on a monthly basis at our women's business centers and the internal help that I referenced for those of you that become loan clients. It's an ongoing, expanding thing that we understand as being extremely important for the business success. When you get shared this deck, you will have these links are all hyperlinked, so you'll be able to access any of the programs that I've described, and also reach out to our Women's Business Center to give them a call. And I always like to give a plug to please follow us via our social media contacts, LinkedIn and Facebook and beyond. And there we can teach you, and you'll learn about all kinds of grant opportunities and many of the programs that come down the pipe that we help our partners advertise. So thank you, Chris, and Eric, I'll turn it over to you.
Good morning. Thank you, Ray. Thank you, Chris, for the introduction. Definitely a pleasure to speak with you guys this morning. What I want to talk about this morning are 3 programs that are big for ACE right now, in a way that we're able to help more people like never before. The first program that we have is the SOAR, the Southern Opportunity and Resilience Fund. Right before the pandemic, the fund came together, spoke with a couple of CDFIs and said, hey, we need to get money out on the street. We need to try to get the rates as low as possible, reasonable terms, and just get the money into the hands of the business owners so they can keep the doors open, weather the storm, get through the pandemic. So ACE, as being one of the partners, we provided capital to the fund, and we opened our doors to applications earlier this year. Samir, next slide. So the qualifications for this program, you have to be an existing business at least through 2020. The maximum loan amount is $100,000. It is a fixed interest loan, which means the rate will never change. 4% is the interest rate. There is a 4% origination fee that's associated with this loan. And the repayment agreement would be up to 5 years. On this slide, you'll see a list of all the other CDFIs with the regions that these other CDFIs cover. ACE, we only cover those businesses that are in the state of Georgia. Our trade areas within our 68 counties, basically drawing a line up under the city of Atlanta, going up to all the borders, Tennessee, South Carolina, North Carolina border. Another program that we don't necessarily have a slide for that I want to talk about is our Save and Sustain program. So our entrepreneurs who have been in business at least 1 year, let's say that you have a facility that you own or rent and you want to retrofit, you want to put in LED lighting, you want to do those type of improvements to the building to get your power bill down. We're offering 1.99 up to 5 years, specifically for the equipment to purchase in order to do those retrofits. That program has been around with ACE for a number of years, and every year we do our best to recycle those monies. So I definitely wanted to put that out there. The third program that we have, we partnered with one of the largest banks in the state, in the country. And we said, hey, we need more capital. We want to do the same thing that we're doing with SOAR, but we want to make it a little more appealing. We want to be able to give true working capital to these small business owners with not a whole lot of rigmarole, I guess, if you will. So Wells Fargo provided capital to ACE to where we were able to provide working capital to business owners. Monies can be used to purchase equipment, inventory, vehicles. If you're in a position to where it's time to go to the next level and purchase real estate, moving from a leased office space to a facility of your own, we can use the capital specifically for those reasons. And again, that interest rate is at 3% and with a 1.25% origination fee. Funds are limited for that program, naturally because of how appealing as it is. So we definitely want you all to apply with us. If you qualify for the program, we'll definitely put you in there. We can talk further about it. And I would say those are the 3 main programs that we have right now to provide for our residents of Fulton County and those others that are in our trade areas. So with that, I'll turn it back over to Chris.
Thank you, Eric and Ray, for those that presentation there. And thank you, Samir, for having us. Again, I know we didn't answer everyone's exact scenario. That's why we want to leave time for the Q&A session. So Samir, I'll hand it back over to you to open that part of the presentation.
I appreciate it, guys. And again, would encourage everyone that's on the call today to just submit your question via the Q&A there at the top. And again, I think a good overview of, especially from the seat of a practicing lender, how you take a very thorough but regimented approach in how you evaluate companies. It was great to hear about the flexibility of the 3 C's and how it's not kind of all dependent on either past or current success. And so it's good to see that kind of evaluation. One of the questions that we did have that came up, which I think is a great one. Again, we've invited both entrepreneurs who are in that early stage of either an idea formation all the way to kind of small business owners who are looking to grow their companies to that next phase. But for those entrepreneurs out there, when you're meeting with them, if they may not have a strong financial background, they've got, and I feel like I hear this as well a lot, a great idea, something they want to activate on, but may not fit that more formulaic financial background that you traditionally would want to see for lending opportunities. What is a way that, again, an early stage entrepreneur with a great idea who may not have a strong financial background or elements to show to a lender, any good best practices on ways that they could demonstrate that to a lender, or other ways that they could access capitals through investors and the like? If anyone could speak to that.
Eric, I'll let you take a stab at that as an underwriter. I have a thought, but I'll see what you say first.
Sorry, I was trying to unmute myself. So I would say if we have someone who has just a great idea, don't know exactly how to make that idea come to fruition, I would say definitely reach out to your local WBC, your women's business centers. And if you have connections with a lender, having a conversation with the lender specifically to be able to coach you through what those next steps look like. Earlier in the presentation, Chris had mentioned about the business plan. I like to say that the business plan is almost the guide map to how your business actually will work day to day. You know who your managers are, who your grunt workers are, but what is the bread and butter? What are we really doing? What service or product do we really have that is worth putting out in the market? So marketing, being able to articulate exactly what it is that you do is key to not only having the lender comfortable in order to provide capital to these businesses, but also to your consumer, that they have a clear understanding as to who you are, why you exist, and what you have to offer. So I would say definitely that coaching component plays a large key. It plays a large part in how that business unfolds and comes to fruition.
Yeah, I agree, Eric. And I will also say we do have a program that's run by our Director of Community Development, Mrs. Vonda Eccles. She wasn't able to make the call today, but we have a program called the Empowerment Loan Program. And it is truly for those early stage entrepreneurs. It's a small program. It's usually loans up to $10,000. So it just depends on what you need the capital for, and if that program may work for you. But we do have something. But I do want to echo what Eric stated about using your WBCs. If you have an idea and it's very early stage and you're not so confident about your personal financial history, your business financial history, start with the WBC, start with the SBDC, and see if they can help you get the documents on paper in the format that we could use. And again, don't hold yourself back because of one thing on your credit score or one thing on your cash flow statement. That's what CDFIs are here for. If there's a way we can make it work, we'll make it work. And if it's just impossible, we'll guide you in the right direction. Say, okay, this is what needs to happen for us to get you loan ready.
And just to piggyback off of that, And Carly asked a very, very good question, because one of the things that we had to do, and Eric can attest to this as well, is that during the pandemic, prior to the pandemic, we were doing startup loans on a regular basis. It probably consisted of about 40% of our portfolio. And Carly expressed concerns that, again, the idea piece, and Eric's exactly right. That's the job of the business advisory team on the pre-loan side, to provide that coaching and provide the necessary tools to help you put together a 3 to 5 year pro forma and all of that. But on the underwriting side, I just want to give encouragement on the lending side, that both ACE and regular banks and community development banks are going to start pivoting back to what was normal pre-pandemic in terms of offering viable startup products for businesses that have a good idea, have gone through, as the guys have mentioned, the paces with our WBCs at ACE, SBDC, and SCORE and beyond, have a great plan. Eric said something, I believe, earlier on in the presentation, the importance of keeping your existing revenue stream, your day job, as I call it, is also a viable part of that. That way you're bringing a global perspective to the income component of this, the revenue piece of it. And we know that until you get up and running at full speed, that there is going to be some capacity there to repay the debt obligation as you move forward. So I hope that's helpful.
No, that's great. And we when we originally held the Empowering Entrepreneurs prior to the pandemic in person, we had a great session around working on your elevator pitch. And from entrepreneurs to more seasoned later stage small businesses, it was very revealing, I think, and interesting to see that discussion where, again, I think people were very invested in their idea, had a great sense of what their business was, but maybe lacked, again, that ability to communicate what is the value proposition, right? It's one of these, I think you can kind of talk it over in your own head and have comfort with that idea, but being able to kind of communicate that value proposition to another investor or to an employee that wants to sign up with you, I think can be an overlooked piece. And that's why I'm really appreciative of ACE really hammering home this piece around the technical assistance, because I do think some of those more foundational documentation elements, and again, really understanding what the business performance and business success and being able to articulate that to others, it's just a critical piece of this loan discussion. It goes way beyond just meeting the basic metric parameters that I think lenders are looking for. So I appreciate that piece of the discussion there. And I think we're getting a lot of questions around how do we connect with some of the programs, especially the ones that ACE is offering directly. Again, we'll send a follow-up email to everyone that was on the call or attempted to sign on to the call with contact information for our speakers, as well as probably some direct links that'll highlight some of the loan programs that were discussed today. So we'll definitely make sure to share that. One of the other questions that we got, which I think is interesting, again, entrepreneur, maybe we want to call people serial entrepreneurs that had a previous business. I think this example was a sole proprietorship and then eventually became an LLC. There may be two separate businesses, but if I wanted to go to a lender to say I've got past business performance, but it may be separate businesses. Is there a way to kind of present that? Does that kind of add a value add of, are you able to connect 2 to 3 businesses that you may have had in the past, but again, each may have had a different varying degree of business performance success? Is that something that you can kind of attribute to your credit worthiness and something that you could leverage for your next business, if anyone wants to speak to that?
I would say yes. That would be the resume of who the proprietor is. So that past experience, having the business, operating it. As we all know, businesses come and go for one reason or another. So if there was an entrepreneur who had been in business 10 years, but no longer has the business because they sold the business, I would say that would allow us to be more comfortable understanding the skill set of the specific proprietor, because you created a business, put a valuation on it, and was able to sell, and you wanted to move on to something else. So I would say yes, definitely. If you've had prior experience as being an entrepreneur, it's definitely something that we would want to have a conversation about with the next business venture.
Thanks, Eric. Another question that I saw come up was about micro versus commercial loans and what those uses are for. Either what you traditionally see what a micro loan may be used for versus a more traditional commercial loan, or if you guys have limitations on what those uses of funds can be. And I'll have a second follow-up to that. But if you can just go into detail about the differences of uses and what requirements you guys may have for the uses of those funds.
Okay, so the main difference between the micro and commercial space by definition in the CDFI world, micro would be $50,000 and less as far as what is being requested. Those funds can be used to purchase inventory, equipment, a vehicle, or if it's just working capital. Working capital is used kind of loosely. So working capital could be, hey, Chris, or Eric, we're looking to hire new staff. We need some seed money to get the staff in before the revenue comes in off of, whatever work that they're doing, scope of work that they're doing. So the 50,000 below, 50,000 below is what the micro monies are used for. Commercial would be anything above that threshold. So 50,000 and $1 and greater would be the commercial space. And that's just by definition in the CDFI industry. So those monies can be used for the same purpose of the micro, but a lot of times those are more larger asset acquisitions, purchasing real estate, purchasing heavy machinery and equipment, things of that nature.
Great, thanks, Eric. Another question that I had around, or that I saw around, especially earlier stage companies, and it's a lot of the conversations that we have, although I don't feel, since we're not necessarily in the lending space, comfort to walk someone through this. Obviously, if they're in more early stage, they may not have past business performance. And so, especially when you're checking that box around collateral, they're leveraging some of their personal equity, both sweat equity and maybe potentially a home or something else to help to invest into that business. Any kind of comments around best practices, and again, not over leveraging yourself and putting your personal either income stream or personal equity that you built up over time at risk over a business idea, and a way to kind of think through what does that balance look like?
Sorry.
Yeah, I'll take a stab at that. We'll go back to the debt service coverage ratio when it comes to investing in your business. You want to make sure you keep it below 45%. That's kind of the maximum that you want to do. If you bring in $10,000 a month, you shouldn't be over leveraged more than $4,000 a month. I would just kind of keep that ratio in your head. And when you're investing in your own business, it's kind of almost like the stock market, stuff you're betting on yourself. So you just want to invest responsibly and just keep that balance. There's no generic rule of thumb, but I just know that a bank is going to look at that 40% or below threshold.
Gotcha. Yeah. And I guess tying kind of back to that, closer to kind of that microloan discussion, the type of collateral, especially for loans under $50,000, is that something that a business owner would have to expect, is to put collateral up if it ends up being somewhat more of a micro loan, or can you use cash flow and your credit score to kind of justify making that loan to a small business? So again, something under $50,000, what kind of collateral do you have to put up, or do you have to put anything up at all?
So specifically for our micro clients, we do not require collateral for those requests. It is strictly based on cash flow and the purpose and the experience of the borrower.
And then again, I think I'd be remiss to not necessarily talk about the current climate of COVID. We will have kind of our last Powering Entrepreneurs, our fourth quarter session, I think in November, around taxation and accounting for year end for businesses. Again, I think over the last 2 years, it's been fairly dramatic in terms of revenue losses, documenting closures, and then additional stimulus legislation, so PPP loans, idle loans, and the like, of really how to document all that stuff. But I guess anything that you guys are seeing or ways that you are being flexible, given, again, the variability that's occurring for small businesses in terms of revenue and cash flow and the like, as they try to either lend or loan themselves kind of past this pandemic. Any best practices or, again, ways that you guys have altered your evaluation process to kind of account for the unique circumstances of the time?
Absolutely. I'll take a quick stab at that. When we require you to submit your documents, we look at 3 years of personal and 3 years of business. So we don't just grade off of the most recent year. We look at the entire picture. And so obviously your credit score will help determine that as well. So if there was a distinguisher pattern, like 2020, your revenues went down, so income went down, of course, then that's understandable if 18 and 19 were fine. And so we can look at a 3-year period versus just a one snapshot in time. Eric, if you want to add to that, you're more than welcome to.
Yes. As an organization, we had to take a step back and see exactly what were best practices. What is the new practice? We can't go off of how things were in the past. What is a new way for us to be able to provide capital to these businesses, understanding that a lot of businesses had to shut down for a period of time in 2020, understanding that, jobs were lost, the whole gamut of what the pandemic, the impact of the pandemic on the world and to our state and our country. So what we've decided to do is we want to look at the last few years, as Chris mentioned. We want to look at the last few years' tax returns, specifically for the larger clients. The larger loan requests over 50,000. We want to see what happened in 19. We want to have an understanding of what happened in 2020 and where you are today. So those interim income statement and balance sheets for 2021, we can use that as a map to see if you're back on the growth path or if you're back to the levels of where you were in 2019. If the answer is yes, then that gets us more comfortable with providing capital. If the answer is no, then there's further conversation that we want to have with you. We want to know, did you receive any of the PPP funds? Did you receive any of the idle monies? Or maybe the shutter venue grant monies that were out as well from the SBA, and what those monies did for your business and what you're trying to do to pivot from the position that you're in back into pre-pandemic levels. So to Chris's point, we kind of look at the overall picture and we don't just look at just the cash flow, because we are very understanding that 2020 was a rough year for everyone.
You were great. Thanks, Chris and Eric. Maybe just one or two more questions here. And I know some people joined us a little late. I really like this idea around the 3 C's of character, cash flow, and collateral. And I think we kind of keep seeing questions pop up about, if I'm deficient in one, how do I kind of make up ground either in others, or how do I kind of fill out that piece, especially around credit history, and maybe not necessarily having the best credit history? Is it kind of the recommendation? Again, I understand that each circumstance is unique, but would you say the kind of the recommendation there is to hunker down, as you, I think, recommended in the presentation earlier on, around evaluating your credit score, making sure that your credit score is right, and then really building out a plan over a certain period of time to get that credit score up to that $600 or 600 level that you guys mentioned earlier? Or are there other ways, again, if maybe you can't have so much of an impact on your credit, are there other ways to demonstrate the viability of the business, and then more importantly, being able to go and ask for those loans or access to credit? Again, assuming that your credit score may not be the best. I think we've somewhat spoken about this, but if we could just kind of hammer that point home.
So Samir, before I let Chris and Eric respond, as part of the resources that we talked about on the business advisory side of our house, there is one group, external partner, Money Management International, formerly ClearPoint, a nonprofit that we're very familiar with. But when there's issues and challenges regarding credit specifically, we make it a point to refer those folks directly to them, and then they can do a very granular, detailed review of the credit, look at judgments, look at collections, look at issues and concerns, and actually be proactive about getting those corrected. Sometimes it takes a little bit to get done, but it does ultimately help in the long run and then makes you credit worthy. So I'll turn it over to Chris and Eric in terms of other mitigating things besides the credit piece that we may be able to look at, but I wanted to just lift it up that we do have that available.
Yeah, thank you, Ray. I'll take a quick stab at it and let Eric go as well. But I just want to remember, again, it's three legs to the stool here. Again, let's say your credit score wasn't a problem. Let's say it was 700. You could still technically be declined if the collateral and cash flow components don't make sense. So if the collateral and cash flow components make sense and you're struggling in the credit area, and we can explain that because that's due to a job loss, that's due to COVID, that's due to, you know, maybe a recent divorce or something like that, we can explain it, then we're not going to decline a loan based upon something that we can explain. But if you're in a situation where, again, you just foreclose on a house or maybe a car repossessed, you may need to go through, you know, some type of credit counseling component first before we can overlook that. But I mean, again, it's three legs to the stool: cash flow, collateral, and character.
Great. And I think the last question that I have is around documentation. Maybe some of the biggest mistakes that you guys have seen around putting together documentation. As you mentioned, I think ACE does a great job in providing technical assistance, and others like the SBDC around putting together a P&L statement, demonstrating your cash flow and the like. Obviously, it's important to present the true facts and the true merits from a legal standpoint. But again, any kind of best practices or biggest mistakes that you've seen in people either trying to personally do calculations and doing this and submitting their own documentation, as in any, I guess, business line, there's tons of consultants and the like, likely accountants that would help you kind of put that documentation together. But any best practices for those who may not, again, be fully up to speed on putting that documentation together, so either going through technical assistance or, again, biggest pitfalls that you've seen in the way that people are organizing that really limits their ability to access capital or to get some lending.
Absolutely. I'll let Eric answer more in depth. But the number one thing I see is that, you know, as a bank, as a CDFI, we typically add back interest and depreciation if you write that off on your report, on your taxes. But let's say you had a one-time expense. Let's say you're in the real estate business and you had a major plumbing repair, and that plumbing repair cost your business $50,000. Well, we can typically add that one-time expense back to your cash flow. But if you're writing off $50,000 in plumbing repairs every single year, then now you've established a trend. And so we cannot add that cash flow back to your statements there. So I would say that's probably the biggest downfall that I see, is that people kind of establish a trend, a baseline with their expenses, and it comes a little bit too high, and we can't justify adding that capital back. So Eric, I'll let you elaborate on what you think.
I actually was going to use the same scenario, one-time expenses that are not customary to your business. To Chris's point, having some type of huge plumbing repair, or a storm came through and blew the roof off, things of that nature. I would say also that having that conversation and just being upfront and honest with your lender or whomever that you're speaking with inside the organization, that helps us make a better case for you. Again, the more transparent it is, the more transparent it is, the more that we know more about you. And we would be more comfortable, what have you, asking questions regarding about your business, your management, things of that nature. Because we seek to try to make a deal work for you. I won't say that we're not like a bank, but we don't try to decline a loan just because we can. We try to find a way to where we can make it work, because we want these small business owners to thrive and leave a legacy for their business, for their family. But not only that, but also creating jobs. That's really what we're here for.
Well, thank you, Eric, again, for closing on those remarks. Again, a big thank you to Chris, Ray, and Eric for presenting today from Access to Capital for Entrepreneurs, better known as ACE. Besides the fact that they have just been great stewards in the community here in Metro Atlanta, especially here in Fulton County. Again, I think you guys just give, besides the technical piece of what lending looks like from your perspective, I think having that strong community lens and that diversity, equity, and inclusion lens is why ACE has just been a great partner here for Fulton County. And again, having that broader vision to see small businesses, especially those that are a little bit more disadvantaged from the traditional markets, be successful is something that we're motivated to be a part of and very supportive of. So just appreciate your time and willingness to present today and then answer not only questions, I guess, during this webinar, but questions afterwards. And again, a recording of this webinar today will be made available to everyone who joined the call. It is something that we will post back on our website for people to review, and similar with the presentation, as well as contact information for the individuals that spoke today and some of the lending opportunities that they've mentioned. So thank you guys for joining. Before we wrap up today, I just wanted to send a quick reminder to the group, and I'll pull it up here, about our Size Up tool. Size Up is our small business intelligence tool hosted on our selectfultoncounty.com website. It's just selectfultoncounty.com/size up. It is a very powerful small business intelligence tool made available free to the public. We have a little video there that explains what the tool can do. And again, it's very user-friendly. There's only 2 data points you have to plug in: the industry your business is in and the location, one of the 15 cities that make up Fulton County, where you plan to locate or are locating your business. Kind of the 3 components there that Size Up offers is you can rank your business performance compared to other industry competitors there locally. So if you own a coffee shop, what is the business performance in terms of revenue, employee count, employee turnover, healthcare cost of other coffee shops in that area? You can also leverage the tool to discover potential customers, suppliers, and better understand your competitive landscape. What's great is it puts it on a nice map so you can really visualize that locational data. And then lastly, you can kind of optimize your advertising to target ideal customer segments, leveraging some of the additional small business intelligence elements. Again, that's something being provided free to the public by Select Fulton, and that's something that we will share as we close out the webinar today and with our follow-up. I think Commissioner Hausman is still with us. Any final closing remarks, Commissioner, that you wanted to offer up there? Otherwise, again, thank you for joining us today. Please look forward to our follow-up emails that we'll send out after this call. We'll have our next 3rd quarter Empowering Entrepreneurs event on September 21st around marketing your business, kind of speaking to what I mentioned earlier around, do you know your elevator pitch for your business, and then how are you taking that on the road to really accelerate the growth for your company. With that, I will leave you 1 extra minute of your day and appreciate everyone's time and contribution. Thank you.
Thank you, Samir.
Thank you,
guys.
sir. You'll be well.